tower industry in 1997, Clayton has personally closed over 135 deals, including mergers and acquisitions, sale leasebacks, and private debt and equity capital placements, totaling in excess of $1.7 billion of value. In the tower industry, Clayton has worked on a myriad of portfolios involving wireless carrier-owned towers, build-to-suits, and broadcast tower sites. He regularly serves as a featured speaker at numerous industry conferences, including CTIA, PCIA, IWCE, and is a guest columnist for industry trade journals. Without further ado, Clayton.
Well, our time is brief. We have an all-star panel here, and I know everybody wants to dive into questions, but first we're going to go down the road. Everybody's going to introduce themselves, and then we'll jump into the topics.
Hey, Rick Prentice, Raymond James, Managing Director of Equity Research. Background, 17 years at Bell South, 19 years now on Wall Street. Wrote my first tower report at the Tower of Babel back in January of 1999, so we're coming in the tower space for over 16 years. I was the first guy to cover the tower stocks from the telecom side. I'm the first analyst really that probably spends a lot of their time also on the real estate side. Maybe twice a year, spend about a third of my time with REIT investors, which is a very important part of the story as well. That's me.
I'm David Wiseman, President and CEO of Brynestad of Wireless, secondary tower company, telecom, been in business since 1997.
I'm Brendan Cavanagh. I'm CFO at SBA Communications. I've been at SBA now for a little over 17 years, and seen it go from about 100 towers to over 24,000 towers today. Bill Brown, President of Quantum Group, 18 years in the business, and interested in watching it grow.
Mark Yancey, CEO of Digital Bridge Holdings and Executive Chairman of Brokerage. 21 years in the industry and in my third reincarnation.
Good afternoon, everyone. My name is Ron Smith. I'm the Senior Vice President and CFO for American Towers U.S. business. We have about 40,000 towers in the U.S. and over 100,000 globally.
Ron Bizik, I'm the CEO of Tarpon Towers. I have 26 years in the industry. Starting out with SBA for the first guy.
Brynestad of Alpina Capital. You beat me by 1 year, 25 years in this space, but towers really, you guys started the tower business, so we were watching back in 94, 95 when the early consolidation started. Before that, PG. And believe it or not, it was PG.
I'm Jay Brown, CFO at Crown Castle. I sound like a virtual rookie compared to these guys. I've been at Crown Castle since 1999.
Okay, thank you, everybody. So macroeconomy and the capital markets appear to be very healthy. For the public tower company CFOs of the panel, what's your current view of the market, the economy, and how does it impact how you think about following topics such as capital structure, M&A, leasing demand, international investment, like Soft Jay?
Sure. Obviously, we've got a phenomenal backdrop of the business, and capital markets have been very good for a lot of sectors for a number of years. We have the benefit not only of having an opportunity to raise really low-cost financing, which we take advantage of over time, but we've also got terrific tailwinds in terms of the wireless industry. All four of the big operators spending significantly to improve their networks. We have a great benefit of getting both trends running in the right direction for us. In terms of capital structure, and maybe we could outline and talk about various capital structures, maybe that's interesting, or maybe it's not. But over time, we've chosen to de-lever the business from where we were at historical levels. We were in the periods of time in our business where we were acquiring the vast majority of the assets that we own today. We ran leverage at a level much higher than what we are today. As the business has matured some, and we've gone towards an approach of really focusing on lowering the overall cost of the capital. We've chosen to take about 75% of the cash flow that our business produces and distribute that out in the form of a dividend. We believe that over time that will lower the cost of equity as a higher percentage of the return is more certain for investors. And the second component of that is risk around the balance sheet. So we've chosen to focus on achieving investment-grade credit rating. We believe that will require somewhere in the neighborhood of about five turns of debt to EBITDA. And our business today is just a little
Robert Brennan.
Hey, John Bell. Next to line, and then we'll pass it on to Ryan. So I'll address, I guess, two of those questions, Clayton, that you raised. One is the capital structure in light of this macro environment that we have. So our capital allocation hasn't changed in this environment, and our capital structure is such that we are an investment grade credit at this point, and that's important to us, and we're committed to keeping that investment grade status. We target leverage between 3 and 5 times. We allow ourselves to go above that at times when there are certain acquisitions available. So we did go above that when we bought Mark's prior company, GTP, in 2013. We went up to 5.8 times leverage. And we committed to getting that right back down below 5 and in that 3 to 5 times range within 18 months. And we were able to do that. We delevered pretty quickly. So we did get back down below 5 times. We then bought Verizon. We just closed the Verizon transaction. We spent a little over $5 billion on nearly 11,500 assets through a prepaid sublease structure. And in that scenario, we again went above our range of 3 to 5 times, so in the mid-5s, and we'll end up delevering down pretty quickly again. And again, with a goal towards maintaining that investment grade, I think that's important. In this environment with interest rates low, eventually they will rise. We think we're pretty well insulated from interest rates rising. Our debt structure is 80% fixed. We've been pretty opportunistic about laddering out and getting our rates down, so we're constantly looking at our debt structure and pushing maturities out, making sure that they're staggered and trying to do what we can to reduce the cost of that. So that's worked really well for us. And so that leaves us about 20% of the interest rates that we have are variable. Then when we get into the capital allocation, we are a REIT, so the first place the capital goes for us is paying our REIT dividend. We're committed to increasing our current REIT dividend about 20% a year over the next 5 years. And then after that, we want to reinvest capital back into towers. So we build towers in the U.S. and we build towers globally. We're in 12 countries on the globe. And after that, we'll buy towers. We'll acquire towers. And then our final kind of waterfall, if you will, in capital allocations, we will buy back our shares if there's no other opportunities that are better for our investors and we're within our target leverage ratio. So all that said, our capital allocation strategy has not changed at all in this market. The interest rates really are low. We think about M&A a little bit differently, but I think we'll address that in a different question.
Yeah, well, this is one of the areas where tower companies do differ a little bit. We at SBA have had a much higher target leverage range over the years. Our target leverage is 77.5 turns of net debt to our last quarter's annualized EBITDA. And that's really been our target range now for, I'd say, about six plus years, really since the fall of 2008 where we had the capital markets crisis. I think it's arguable that leverage could be actually carried at a higher level, but we balance that against those situations that can occur, like we saw in the fall of 2008. We do things to protect ourselves, including, as Rod mentioned, staggering our maturities out, making sure that we're raising money in multiple different markets so we're not beholden to any one particular market. And we stay a couple of years ahead of maturities as well. So from that standpoint, we feel very good about it. What I think is important in determining what's the appropriate leverage is really looking at the underlying business, the fundamental strength and consistency in the cash flow, and not only in the current cash flow, but in the growth of that cash flow year after year, creates great stability that supports a significant amount of leverage, which is why we carry the leverage at the levels that we do. And as a result of that, and in fact, we've had a tremendous capital markets environment, as Jay mentioned. Rates have been obviously at low levels now for 10 years or more. We've been a beneficiary of having been able to raise that additional leverage, pour it back into the business, acquisitions, new builds, ground lease buyouts, and even in our history, stock repurchases when there haven't been opportunities to do good price acquisitions. And by doing that, we've been one of the fastest growers in the industry. And so today, given the current capital market situation, which is very strong, and given the strong underlying fundamentals of the business, where you look at acquired wireless data consumption in particular, is expected to grow at a record pace. We feel very good about that strategy, and we expect to continue our strategy as we have the last 10 years.
Great, thank you. We'll go back to Ron, Brendan, and Jay, and a couple of other panelists with the next question. Things are looking really good in the short and long term in the tower space, but as evidenced by the bios, people have been in the space for a long time, and we've seen a couple cycles. What do you see as far as some of the concerns on the horizon, things that keep you up at night, and things you're watching in terms of big industry game changers? Start with Ron.
Yeah, so this tower industry therefore is inherently non-cyclical. And the demand drivers for towers is really depending and driven by the stage that the carriers are in the network development, not the macroeconomic environment. And the demand has been really strong. I think everyone in this room would agree, they see their own businesses, that the carriers have been very active and the demands have been strong. So when you think about interest rates rising as a potential risk, we don't worry too much about that, although we do plan to evaluate that. We think we're somewhat insulated from interest rates rising because of the nature of our capital structure. Leasing demand in 2014 was really good, almost unprecedented. The U.S. Tower division of American Tower grew at nearly 9.5% for organic growth, which was the best we've seen in a long time. And coming into 2015, we still see strong demand. We see that in the US, we see it outside the US. So we're looking in the U.S. for organic growth to be within our target range. We publicly stated that we expect our U.S. business to grow between 6 and 8% over the long term. We think we'll be right in the middle of that in 2015. So we're certainly pleased with the demand drivers there. And the carriers have begun to shift. So in the U.S., AT&T, Verizon have completed their LTE build-outs. They're coming back in now and adding capacity sites to improve the quality of the network. They're adding coverage sites. So we're seeing a shift from amendments to new colos, and that's certainly driving some of that more organic growth for us. And we also see T-Mobile in Sprint kind of the tail end of their LTE rollouts. They're finishing that up. And we would expect that they'll begin to shift more towards colos and build out the new spectrum that they just bought and start deploying more colos and less money. So we feel good about the demand drivers going into 2015. I guess on the risk side, we've heard a little bit this morning about small cells, and that could potentially be a risk in the tower space. We spent a lot of time thinking about small cells. We've invested in in-building networks. We've invested in outdoor gas networks. We are deploying some lower level, similar to macro sites, where the carriers will install them 30, 40 feet high. Sometimes they're on the antenna, sometimes they sectorize them. They consider those as small cells. So we look at these businesses. We certainly have a number of rooftops. We invest in outdoor gas. We invest in indoor gas. But we view those businesses as very much complementary to the macro sites. We do believe that the macro sites are the first choice of the carrier in every instance. That is over and above the rooftops being built in the outdoor gas. When it comes to the small cells, the Wi-Fi networks of the outdoor gas, they're very complex to design, they're very complex to build and construct, they're very complex to operate. And the networks that we have over 500 nodes that are on outdoor gas networks, and they've been in place for a number of years. We haven't seen the same level of organic lease out that we see on the towers. So our tower portfolio runs on average about 2.5 tenants per tower. Our in-building networks run at about 2.5 tenants per tower. Our outdoor networks run at about 1.1. So it's a dramatic reduction in the lease up. So the economic model there is challenged. So as we think about small cells, we do think it's coming. The carriers have a problem that needs to be solved from the urban cores. They will find a way to solve that. We see that as very much complementary to the towers, not necessarily competing with the towers. And again, we think the carriers will choose macro sites every chance that they have. And then in terms of new deployments, new networks, Dish has a lot of spectrum. A company called Lightsquared has a lot of spectrum. People talk about FirstNet deploying their network. And in those cases, we think Dish and Lightsquared, their spectrum is very valuable. It's very difficult to predict when to build it out and how they're going to build it out and what it really means to the tower companies. But we do believe that spectrum will get built out at some point in the future. And when it gets built out, that should add to the core organic growth of all the tower companies. And FirstNet, again, is in a similar situation. It will come. There will be a first responder network in the U.S. Not sure exactly how it will be deployed. whether it's a standalone network or it's separate installations, or if they're running the backs of the embedded wireless networks out there, but we'll wait and see. So with that, with all that said, I think there's a lot of opportunity, a lot of strong demand, and we don't see any technology or any other risks that are directly competing with towers anytime soon.
Well, I would agree that there's not a lot of risks that we see out there today. There are things that could be game changers. I think there's some things that could be positive. I'll touch on a couple of them. In particular, you've got Dish or Spectrum. You have public safety out there. Those are carriers, if you will, that have not contributed historically to our growth and activity levels. So to the extent that we start to see some activity there, that's obviously an incremental positive to what we've seen in the past. Ultimately, one of the things that's, I think, sometimes missed by investors and folks who watch the tower industry is the consistency at which it operates. A lot of people say, yeah, I know it's always there, but even during times where the market as a whole is in disarray, the economy is in bad shape. If you look, for instance, we'll go back to the fall of 2008, a terrible time for the markets and the economy as a whole. And while our stock did get punished a little bit, it had to do with people's concerns over leverage, the fundamental operational performance of the business never actually slowed down. We continue to have growth in EBITDA, continue to have tenancies and additional amendments to our towers. And so it really is a very stable, consistent business. And so I think, although we have periods where one carrier is very active and then not so active the next quarter, those things over time level themselves out. And last year was a record year. This year may not be as high as last year was, but all the carriers are very busy, and I would expect that towards the second half of the year, we'll start to see that pick up again. So there really isn't a lot that we worry too much about. We look forward to some of the additional possibilities and things that haven't yet occurred that I think are sitting out there could be very meaningful to the growth of this business in the future.
I think these guys have done a great job addressing most of the technology risk. Occasionally those come out, we obviously look at it frequently. One of the things that we look back on, though, nobody understands better the technology than our carrier customers. And today, every time they go on a tower, they're signing between a 10 and 15-year commitment. And the amount of cost and effort that they put into actually locating where these macro sites are going to go is significant. And it's their view for a very long period of time that they're going to be co-located on these sites. And I think that probably speaks more than any research we can do anywhere else is the commitment of the carriers to these sites. The other risk that I would say, we thought this for a very long period of time, you would have to be really dumb to break a tower company. And so most of the risk, frankly, when you invest in a tower company is about sub-optimizing what could be the outcome. And so as we think about allocating capital, it's never around whether or not a particular investment clears at a given hurdle rate, because frankly, everything in the tower business clears a reasonable hurdle rate given our cost of capital. It's all around what is the best outcome and optimizing that outcome against various alternatives. And so as we think about allocating capital, we think about the best alternative relative to other alternatives. And for a long time, that has been things in our business like buying stock. Most recently, it's been meaningful investment that we've made into small cells. Today, small cells make up about 7% of our consolidated revenues. We've seen year-over-year growth in small cells of about 30%. And believe that it's sort of the next wave of deployment that we're going to see from the carriers in the U.S. in an outdoor system as they work to improve the capacity and coverage of their networks. And so we've been spending a lot of time there and capital there. Today, our total investment in small cells, which approximates about $1.7 billion, the yield on all of that investment today is about 7%. So if you compare that to the tower acquisitions that have been done over recent years, somewhere in the neighborhood of about 5% initial yield, we're in the very early stages of the first couple of years of investment there and already at 7% yield. So we think the returns there are among the best of any alternative that we have in front of us, and we're pretty excited about where that business can go to over time.
Give Rick and Phil's perspective. Rick, you've covered the space for a while. What do you see as any potential threats that are coming down the road?
Sure. So actually, I want to go back to the start of the question about we've seen a couple of cycles as you saw on the panel. Interestingly, I was reminded of a story I had Tom Martin, CEO of the Tower of the neighborhood real estate investor asked Tom, what would cause your revenue to go down from year one to year two? And Tom started answering the question, well, we had less leasing activity, we might see growth decline. And I said, no, what he's asking you is what would cause revenue to go from $100 to $90, not what would cause your growth rate to decline from 8% to 6%. Because again, those growth thing of cycles, when you talk to real estate investors, a cycle can go whoosh, go right in the toilet, right? And you can see growth of 10% and declines of 10% in your cash flow growth. Those are real cycles. So when we talk here about cycles, it's how much growth are we getting? We're still getting pretty good growth. So that's one thing to step back and say, we get kind of stuck in the wireless or tower industry and think we've seen cycles when in fact we can probably look attractive to other industries when our cycles are pretty minor compared to what people see out there. But that said, interest rates are clearly something that will affect valuation. If interest rates go up, and we saw a period of time where they did go up a little bit, and then we saw times in December, January where they came back down some, and tower stocks moved when interest rates moved. So it's more a risk, say, to the valuation as far as what people are willing to pay for this business. FX rates, same thing. It creates a risk of the translation as far as how much you get paying for acquisitions, how much are you going to earn back on those acquisitions, and it's something we have to address. And I think we've got companies with different strategies here, but it's something that can affect the valuation of what people are willing to pay for that cash flow. Don't hear anybody talking about consolidation. That seems to go in and out of vogue. It wasn't that long ago that last summer when the FCC chairman was taking his victory lap at CTIA for having squashed the Sprint T-Mobile merger. We go back to the PCIA a year ago, though, people were worried, right? And that's just a year ago, people thought, what happened to Sprint T-Mobile come together? As a wireless and tower analyst, we would actually like it probably if Sprint T-Mobile were to merge, make for a stronger competitor, somebody who could earn a return on capital and would actually spend the money, but the headline risk is there. So you have those headline risks. You have those same carrier consolidation headline risks in Brazil, and probably some other countries as well. I was on the T-Mobile conference call because Jennifer's here, Jonathan's here, several of my peers on the Wall Street side are here. Awkward for us to travel during earnings season, makes it tough when T-Mobile has their conference call and it's a very big customer of the tower companies. But the question came up at T-Mobile today about consolidation, and John Leonard is a very entertaining character. Said it's not just a question of if, it's really a question of when. And then he added today, it's a question of who. And then it might not just be a consideration of is it 4 going to 3? It started continuing to lay the seeds of if industry consolidation were to occur, could there also be somebody from the technology field coming to play? Google, we know, is going to do this MVNO. You hear people talking about what Facebook does. There's a lot of technology companies that might fit into the mix as well. So consolidation might not even look like what you think it might look like. The final one I want to hit, though, is the technology risk. We talked about it a couple times with a couple of guys on the panel here. We call it the left field question. What if something comes that we're not thinking about? And that's always the danger, is when you talk to the equipment guys and the carriers, like Jay pointed out, the tower people, everybody's feeling pretty comfortable. When people sell their companies,